So for the first Federal Reserve meeting of 2023, the Federal Reserve comes right on cue with a 0.25% rate hike going into the new year. Many of market analysts and other economic analysts guesstimated that the Fed would go for a 0.25% rate hike into this meeting due to the fact that inflation has been trending downwards for 3 consecutive months in a row. Overall, CPI has been trending downward. That does not mean every category within CPI has been trending downward, but overall CPI has been trending downward. So many analysts were pretty prepared for the Fed to do a rate hike. Most were guesstimating that they would do a 0.25% rate hike. Some were kind of leaning that there was a possibility it could be a 0.50 or a half a percent rate hike because of the fact that certain economic indicators within the CPI basket are still kind of high and pretty stubborn. So with this news coming in, the stock market has largely stabilized because it priced in this rate hike with the assumption that that will be what they would get. Thus, the reality of it is the stock market responds off of predictability and stability. Being able to know in advance what the Federal Reserve is likely to do helps the stock market to kind of price in the moves and not have such a dramatic response when the Fed meeting comes along. And the Federal Reserve was right on cue with what the stock market was expecting. So there were many questions in this Fed meeting for Fed Reserve Chairman Jerome Powell. Many reporters were asking what were the plans for the rest of 2023. Many reporters were asking questions like, will they be continuing the rate hikes and for how long? Some were even asking if rate cuts were on the horizon. And the Federal Reserve is largely standing on cue with its consistent forward guidance since its rate hikes started. And that is that they're going to stay persistent on rate hikes until they continue to see a further trend downward on inflation. Jerome Powell did speak with positive enthusiasm around the fact that inflation has been trending downward and that the moves the Federal Reserve has been putting in place has seemed to been paying off. But he has cautioned that inflation is still high and still a threat. He's also cautioned that there's a lag effect to the interest rate hikes that we've experienced from last year and the one that we had come in today as of February 1st, 2023. So as to say, the effects of these rate hikes still have not fully impacted the economy. There are also stubborn factors. Gas prices are actually still trending upward, unfortunately. Food prices are still pretty rough as far as inflation is concerned. Housing is pretty stubborn. And unemployment numbers are also pretty stubborn. You have to remember the Federal Reserve is actually trying to get unemployment numbers to go up or employment to drop, right? They're looking for a less competitive, less demanding employment market, meaning to say less people getting hired, less companies paying higher wages to attract new talent. So I shot a video talking about wage price spirals, and this is one of those factors the Federal Reserve is working towards cooling down, which is awkward because obviously having a bunch of job openings and working class and middle class Americans having the opportunity to be paid even more for their line of work to attract their talent sounds like a good thing. But in the overall scheme of the economy, unfortunately, it's pretty unattractive at the moment, and the Federal Reserve is working to slow down this trend. So as far as the real estate market is concerned, the Federal Reserve's rate hike, again, is kind of right on cue. And it seems like the Federal Reserve doesn't have a lot of bluffing power left when it comes to, being more aggressive towards rate hikes. And you look at the 10-year Treasury, which is very heavily pegged to the mortgage rates, even more so than the federal funds rate. This is trending downward. I believe it's somewhere around 3.4%, if I'm not mistaken, which is pretty low. If you look back in previous months, it was pretty high, 5-6%. Maybe even higher than that a few months back or, fall of last year. It's down now below 3.5%, if I'm not mistaken. Again, I'm referring to the 10-year Treasury, which means that mortgage rates are likely to continue to trend downwards. This could have an interesting effect on the economy because if mortgage rates continue to trend downward, we're already seeing an uptick in applications in the United States when it comes to mortgage interest, as far as people getting back into the market to buy. Because again, with mortgage rates going down, this is making housing more affordable again. It's not a huge dip, but it is a consistent dip, and it's enough to get some people off the sidelines. There were articles coming out showing up to a 28% increase in, basically buying activity, or, interest in buying from buyers that have been sitting on the sidelines. So applications rather have been up 28% week over week about a week ago. So that means that if the 10-year treasury keeps coming down and that the mortgage rates come down with it, that we could start to see the first-time home buyers and more of those, middle America housing markets and housing buyers start to come off the sideline again and jump into the housing market and make things pretty hot and pretty aggressive again, which is going to be interesting to see how the Federal Reserve reacts, because the reality of it is, if that happens and the housing market heats back up again, this could force them to take even more drastic measures on the housing market in particular. Even though the federal funds rate is still going up, it's not having the effect on the housing market that they may be hoping for. So more importantly, I want to talk really quickly about what this means for you as those who are, in the workforce or anywhere in this mix that are trying to just figure out what you should be doing with your money from an investing and a banking point of view. From an investment point of view, if you have good, skills when it comes to investing in the stock market, then you probably already know what you're doing. You probably already have an idea that this could be a great buying opportunity for you, because the Federal Reserve is starting to function on cue. And that means that the stock market is going to respond accordingly. So some of these companies that have taken major dips in the last, 2 to 4 months or so could be a great buying opportunity going forward, because the Federal Reserve's the next prediction for the Federal Reserve in March is going to be about another 2.5% rate hike, which again, if the market has priced that in, we can start to see the stock market slowly start stabilizing and maybe even trending upwards. So those of you who are skilled enough, doing your homework, watching earnings, and you know that there's valuable companies that are down right now, that typically the numbers and their earnings and other reports are showing that they are a much more a valuable stock than where they're trading at right now. This could be a great opportunity. Tesla and Apple are two mainstream examples of companies that have shaken back quite nicely in the last handful of weeks from their lows. So this could be a great buying opportunity if you play the stock market and have some skills and do your analysis. Those of you who are still looking to invest but don't have that skill set, you want to start dollar cost averaging into a managed brokerage account or some kind of managed investment account. That means that you're going to consistently put in a consistent flat rate amount, $100 a week, $200 a week, $100 a month, $200 a month, $500 a month, whatever you have in discretionary income, into your portfolio with a professionally managed portfolio. That means that proper suitability has been done on you, and either a robo-advisor or an actual advisor is actually taking over that portfolio and managing it for you. Again, doesn't mean that the stock market is, completely bottomed out or hit its bottom. Things can change. There are other economic factors that are outside of the Federal Reserve that do influence the stock market. But this still could be a great opportunity for those of you who have a managed account or are willing to set up a managed account. Those of you who are not comfortable with investing and are looking for, opportunities to still manage your buying power and keep up with some of this crazy inflation, you are going to want to look for high yielding money markets and CDs and high yielding savings accounts. They are out there and they're doing relatively well. Actually, for the first time in a very long time, deposit rates are actually comparable or close to inflation rates. Inflation is at about 6.5 at the moment, and we'll get up-to-date numbers in February this month. But last we saw it was about 6.5. If it's trending downward, then that means it's somewhere in the low sixes or lower, while deposit account rates are up in the 4s and 5s. So this is a great opportunity for you to at least negate inflation. It's not a victory. You're not going to be surplusing, but you could negate inflation in a safe, risk-free deposit account or low-risk deposit account. Depending on where you are in your financial journey, if you're closer to retirement or right at retirement right now and you're watching this video, you want to start weighing out options on cash value life insurance or annuities. Annuity rates in particular are also reasonably attractive at the moment. So this is something for you to consider. And if you aren't, looking to get into deposit products, you want a few more benefits than deposit products can offer, and you're willing to get into an insurance contract and look to get a decent return, fixed rate return, contractually guaranteed, annuities could be a great option right now. I am not your personal financial advisor. I am a financial professional giving you my 2 cents on a broader scope on how you can be moving around these Fed meetings and the updates as they come along. But I am not your personal financial advisor. So please continue to seek financial advice from a licensed professional. Again, I'm just giving you some concepts to think about, strategies to think about, educational purposes only. So overall, things are trending in a stable direction at the moment. There are many factors at play. The war in Russia is still going on. China is coming off a lockdown again out of COVID, and their economy getting back in motion could open up supply chains, but also could put a demand on the energy markets because they are back functioning. So there's just a lot of intangibles, a lot of nuances that are outside of the Federal Reserve that can play into our economy back here in the US, that can play into inflation, and that can play into our overall interest rates over time and what the Federal Reserve does with interest rates. But I just wanted to bring you guys this update as of the same day. It's kind of late this evening, but I wanted to bring this information to you and finish it off with a little bit of guidance on what you can be doing around the news that has come out. If you're looking to get into the housing market, interest rates could be trending downward for the coming months. While prices are still relatively compressed in some markets, real estate is very local, so do your homework on your own market. But this could be a good time to come off of the fence. Again, I gave my 2 cents on the stock market. I gave my 2 cents on banking products and deposit products and where you could be making your earnings there. Consider all of these things. And as always, I appreciate you joining. I appreciate you taking in this content. I appreciate it bringing it to you. Continue to stay focused. Stay in motion. I'll see y'all soon.